Wonderful. Thank you. Let's get started. Let me just take a 1 minute introduction to introduce myself since there are a few first-time participants. You are seeing me on screen. I am CAN Raja, a chartered accountant by qualification, a teacher trainer by passion. I started my career with State Bank of India, where I joined as a credit analyst, and in very short period, I got elevated as team leader of credit processing cell in mid corporate group, where I had opportunity to work on loan proposals starting from 10 crore to 500 crore. And I handled 250 plus projects, which is almost 5,000 crore plus size. Then after 4 years, I came out and started my CA practice. During practice also, I focused on project finance and debt syndication as my core practice areas. Then I also started teaching to students on the subjects like financial management, strategic financial management, mainly for students pursuing professional course like CA, CMA, CS. Then I was also invited by banks to conduct training program on the areas like working capital, term loan, financial analysis, and I'm also teaching through online platform like this. Thanks to technology, today we have 3 lakh plus learners across 180 plus countries learning banking, credit, and finance. This is my backdrop. Now let's jump into the discussion. The focus is term loan. Why a dedicated session on term loan? Every week I used to answer this. Term loan is not a simple loan. Term loan is not a simple loan. Term loans are not just sanctioned on the basis of past declared income. Term loans are not sanctioned merely on the basis of past declared income. That is, bank is not just going to look at what is the profit they have made in the last year or what is the income declared in the income tax return and then arrive at some percentage and declare. No, I mean sanction. It is not on the basis of past declared income. Rather, it is based on the projected future cash flows, and viability of the project. Okay. So there are two things. One, it is fully dependent on future. It is even possible that in past the business has made loss, still term loan can be given if projected future cash is convincing. Yes, banks will do that also. And they're very much concerned about the viability of the project for which term loans are given. So understand, term loans are not given for some random purposes. Rather, in most of the cases, they are project financing source. They are given for putting up a project. When I say a project, it can be a project undertaken by a new business unit. It can be a project undertaken by an existing business unit. This new business unit is going to start everything from scratch. Okay. So we call it as greenfield project. Whereas existing business unit, they may take a project, number one, to expand their existing capacity, or they may carry out project which focuses on modernization so they can reduce the cost, or they may take up some project which focuses on diversification. They want to add another line of activity itself, or it may even focus on integration. That is, they may either focus on backward integration, or they may even focus on forward integration. So it will help them to make more profit in future. So look at here. I said term loans are given for project, and within that itself, we have subclassification like this. If it is a new unit, we call it as greenfield. If it is an existing unit, there are multiple combinations. The existing unit expanding their capacity or modernizing their manufacturing setup, or altogether getting into a different line of activity, diversification, or doing some backward integration or forward integration. So what is the focus of all this? If you carefully observe, all this involves cash outflow now. Cash outflow now. That is, cash is going to go out now. Whereas inflow is going to happen in future. And this future only, in this future only, they will make sales, they will incur expenses, and in the process, they will make profit. And using this profit only, they will repay the term loan interest, they will repay the term loan principal. So are you getting the flow? The flow is like this. The project is put up now. Okay. For that, loan is going out of the bank now. And this business, using the money, they will complete the project. And using the project, they will either focus on achieving more sales and making profit in case of expansion, greenfield, or they will reduce their expenses and make profit like modernization project, or they will altogether get into a different line of activity and make more sale and make profit and repay the loan, or they will get into some backward integration where they will be able to control their expenses and make more profit, or they will get into forward integration where they'll be able to make even more sales and make more profit and pay the loan. Okay, so look, everything happens in a different pattern. Everything happens in a different pattern. But what is common here is cash is going out now, investment is happening now, whereas its reward is expected in future over a longer period, right? The investment will happen now, 5 crore, 10 crore, 100 crore, whatever it will happen now or within 1 year period. But if that business has to take back, recover that investment and also pay interest, it has to wait for a longer period. Okay. And this longer period, in this longer period, they should be able to make profit. And that profit should be adequate enough to pay not only interest, but also principal. Only when the profit is adequate enough to cover both interest and principal beyond certain times of the obligation, then only we can come to a final conclusion. The project is a viable project. Then only we can come to a final conclusion that project is a viable project. And this viability is very important. If the project is not viable, then even if the project is capable of generating future cash, it's not going to help. So what do we mean by viability? That's where we get the next question. What do we mean by viability? When do we say a project as a viable project? If you have to say a project as a viable project, it has to satisfy three conditions. The project should be technically viable. The project should be economically viable. The project should be commercially viable. Only when the project satisfies all the three conditions, we can give a stamp that it is a viable project. Else, it is not a viable project. So now the question is, what do we mean by technical viability? See, using the loan, they are going to purchase some asset, or they are going to put up some project. They are going to purchase some machinery. Now, all the assets which they are planning to purchase, I repeat, all the assets which they are planning to purchase using the loan and put up the project. Okay, I'll just write it as assets. Those assets will have certain expected output, right? Let's say if they are purchasing a technical machinery, then that machinery should be able to work at certain level of capacity and it should be able to generate the expected number of units. So when I say expected output, that machinery should be able to work at certain capacity, right? It should be able to work. It should be able to work uninterrupted. Okay. Then it should be able to generate expected number of units at expected number of shifts of operation, accepted number of shifts of operations. See, all these are very important. If that asset is able to work at certain capacity, but if it is not sure, it will not generate certain number of units. Or if that asset is able to work at certain capacity, okay, it is able to work uninterrupted, it is able to generate expected number of units in the expected number of shifts, but if it is unable to generate expected quality of the finished product, then also the viability is gone. Okay, so if we have to say the assets are technically viable, then those assets should be capable of generating the expected output in expected quantity in and expected quality also. And for that, it should have adequate technology backup. I mean, the process, whatever they are going to adopt, that should be sustainable, that should be repeatable. Only when all these are complied with, we say that machinery or that asset, whatever is going to be used, it is technically viable. So here I just gave you a broad framework. I didn't make it very specific onto which asset it is. If we go little deeper, then we'll be able to dig down into which type of asset. Okay. Let's say a company is planning to put up a factory. So what are the assets they will be acquiring? First, they will invest in land. Then they will invest in building, right? Then they will invest in plant and machinery. Then furniture and fixture, the list goes. So the technical viability starts from each and every point. First of all, the land, whether the land is suitable for the proposed project, because there are certain lands where factory construction may not be possible. So if the land is not suitable, then project technical viability gone, right? So whether the land is suitable. Next, whether the land is adequate enough. I mean, whether the necessary space of land is available in terms of cents or acres, whether it is available. Okay. So you have to ensure the land is suitable, whether the space is adequate. Then you should also take care of the pollution related aspects, because most of the activities, production activities, will cause some kind of air pollution, water pollution. And if you are going to be in a space where these, say, the wastages cannot be released in its normal process, then again the land technical viability is gone. So these are all one simple examples. Again, if you take building, okay, the building, whether building at expected level of square feet can be constructed in that particular area. Point number one, because there will be certain restrictions in terms of number of floors or square feet also. Number two, the building planning, whatever they have made, will it support expected, or will it support the anticipated installation of machineries? Okay. Will it support the smooth production process? If that is not there, then the technical viability related to building is gone. With regard to plant and machinery, it goes deeper into several points. As simple as selecting the appropriate supplier. I mean, if the borrower is planning for X machinery, and if they are planning to purchase it from, let's say, ABC and Company, and if ABC and Company is known for poor quality of the materials or poor quality of the machinery, then here the bank will reject on technical viability, because the supplier what they have or whom they have selected is not of acceptable or is not within the acceptable parameter. Okay, so like this, for each and every item, technical viability or technical angle have to be seen. And uh, as a banker, you may not be conversant, or you may not have expert domain or expertise in finalizing all this. That's why banks always engage TEV consultant. They always engage TEV consultant. These TEV consultants may be either in-house consultants, that is, they are employees of the bank itself, or they may be external consultants. So they are basically empaneled engineers or ex-bankers who have worked in TV departments. Okay, so banks will entrust the job of understanding the technical viability to these consultants, and they will give a report called techno-economic viability report. It means they will not only certify on the technical viability, they will also address the economic viability and commercial viability. So there comes the next question: what is economic viability? See, this company is planning to produce and sell some goods, right? So whether that goods have demand in the market or not, whether that goods have demand in the market, whether there is a market demand. That is, if they produce and sell, will there be takers? Will there be takers? If there are takers, if there is a research, if there is a study conducted and that proves that there is a demand and supply is limited or supply is not available, then we say there is an economic viability. But if the market is already flooded with too many suppliers, then it is not a blue ocean strategy, rather it is a red ocean strategy. It means the market is already flooded with too many players and you are also trying to enter. Then on what basis you will be able to differentiate yourself? On what basis this business will be able to differentiate its product, its services, and create some spotlight so that buyers will come? So unless and until that is identified and convinced, we cannot comment on economic viability. Okay. So economic viability means whatever the goods they are planning to sell in the market, there should be demand, number one. Number two, if there are already too many players, then what kind of strategies they are going to adopt to position their product so that buyers will agree and buy this product. That has to be seen. Okay. And then comes the commercial viability. Commercial viability is very important because if technical viability is satisfied, economic viability is satisfied, and if commercial viability is not satisfied, still the project will be considered as not viable only. Okay. And it is rare that there is a commercial viability and there is no economic viability, or there is a commercial viability and there is no technical viability. Okay. So understand, technical and economic viability both are required. But despite having technical viability and economic viability, there is a possibility commercial viability may not be there. If commercial viability is not there, then the project will be considered as not viable only. So what do I mean by commercial viability? See, using this project, they are either planning to achieve more sales or they are planning to reduce their expenses. It means in this process, they are planning to make more profit, right? Increase the sales or reduce the expenses, so make more profit. This profit should be adequate enough to repay the loan interest, should be adequate enough to pay the loan principal, and it should have some surplus, so that surplus is available for taking care of working capital of the business, and that surplus is available for paying return to the owners, because owners also should get something, no? Making profit is not just for paying interest and principal. It should make profit. That profit should be adequate enough to pay interest, pay principal, and there should be some surplus after paying these two. And those surplus should be there to support the day-to-day operations of the business, and it should also be sufficient enough to pay some reward to the owners. Only when this is established, we say the project is commercially viable. And do you know how banks ensure whether this is established or not? Do you know how or what parameter they look for? Can someone guess? What parameter? Or they actually look for one ratio. They look for one ratio, and using that ratio only they come to a conclusion, yes, there is a commercial viability. Anyone has an idea on this? They will look for a ratio called DSCR, debt service coverage ratio, right? Debt service coverage ratio. So if debt service coverage ratio is there, and if it is satisfying, convincing, then that is a proof that the project is commercially viable. And when the project is commercially viable, economically viable, technically viable, we say the project is a viable project. Overall, the project is a viable project. Okay. So this is the backdrop I want to set for today's session. I think for the first 15 to 20 minutes, I did not give any opportunity for any of you to interact with me. I was just going on the flow. So far, was it clear for all of you? It was just one way of communication. I did not ask any of you to interact or comment anything, but was the flow was perfect? Was it clear? Yeah, Ashish is asking how to calculate DSCR. We'll try to cover that in today's session. Okay, so is that clear? Yeah, Shivam, Ajay Kumar, thank you so much. Megha Chaban. Okay, thank you. Right. So, coming to the point once again, term loan is getting sanctioned now. I call it as timeline 0. This is time 0. And the repayments are going to happen over a longer period. Let's say it's going to happen. It's starting with time 0 over a period of year 1, 2, 3, 4, 5, 6, 7, 8. Let's say this is a loan for 8 years. So in this 8 years period, the term loan have to be repaid. It means what? You have to understand what will be the profit this business will be making using this project. So understand, a company, let's say a company called X Limited, they may be already existing running company. Okay. They already have existing business, and that existing business is already making profit. Okay. But now they are adding a new asset. So banks will be interested in knowing what is the role of this new asset, because this new asset should either contribute to increase in sale if it is an expansion, or it should contribute to reduction in expenses if it is a modernization. As a result, it should contribute to profit, right? So they'll be interested in knowing whether the profit what they are going to get is sufficient enough to take care of loan repayment. So if that is the case, then it will be considered as project on standalone basis is viable, because the project is generating profit either by increase in sale or reduction in expenses, and that profit itself is taking care of the loan repayment. In that case, they'll be happy to fund. But there are certain cases where the new asset may not contribute significantly to the profit, but the presence of the new assets is very important. Okay. So the new asset alone cannot independently ensure the loan repayment within the bank's loan period. Let's say bank will give loan only for 8 years, but the new asset will take at least 10 years to take care of the loan repayment. Then in that case, the bank will judge the repayment capacity by not only looking at the profit generated out of new asset, but also see what is the profit from their existing operation. So if the profit from existing operation and profit from the new activity, if both are aggregated and if they are greater than the level required, or if they are greater than the loan repayment, that is principal plus interest at certain times, then banks will also be convinced with that. Okay. So that's one thing you have to take care. Now, here, if you see, disbursements are happening now, repayments are happening over longer period. It means for this entire loan period, for entire loan tenure, you have to calculate what? For entire loan tenure, you have to calculate everything. It means you have to see for entire loan tenure, that is for each and every year. In this case, year 1, 2, 3, 4, 5, 6, 7, 8, right? For each and every year, you have to see whether this business is capable of making profit. And that profit should be greater than the loan installments, right? Only then we say each and every year they have repayment capacity. So here I'm just explaining in simple terms. I mean, I've not yet started using the technical jargons. What I'm saying is the loan is for 8 years. It means for entire 8 years, you have to calculate profit. And you have to compare the profit with the repayment. But if you want to calculate the profit, you have to calculate something else, something else. What are the things you have to calculate? If you want to calculate the profit, you should know what are the expenses they will be incurring in this period. They'll be incurring expenses on raw material, labor, power, manufacturing expenses, selling general admin expenses, right? It means you should be able to estimate, project all this. And if you want to calculate the profit, you need expenses which we have derived. And you should also calculate what will be their sales in this period. So they may be selling directly manufactured products. Okay. So there can be main products or finished goods, sale of finished goods. There can be some byproducts also coming up in certain businesses, especially people in sugar cane and all, they'll know, right? So you should calculate this not just for 1 year, but for entire year 1, 2, 3, 4, 5, 6, 7, 8. And if you want to calculate for all these 8 years, what is required? You should have a complete understanding of their business model. Yes or no? You should have complete understanding of their business model. What do I mean by saying complete understanding of their business model? You should understand how they are going to make sales. You should understand how they are going to make sales. So how they'll be making sales? They'll be producing the finished goods, and that finished goods will be sold at particular price, right? It means the number of units sold into selling price per unit will give you sales. Yes or no? Yes or no? Number of units sold into selling price per unit will give you sales. But the question is, you have to validate each and every item. You have to validate each and every item. How many number of units? This number of units sold will depend on number of units demanded, because you cannot sell everything whatever you produce. So whatever the client says that we will sell certain number of units, you have to discuss with them and you have to see whether these number of units are saleable or not. If the market is very sluggish, then whatever the units they are projecting may not be saleable. Okay. But if the market is very hot, if there is a huge demand, then it is possible. Okay. So the mere simple first line item that is arriving at the sales, which is nothing but the number of units sold into selling price per unit, is not a simple cakewalk, because you have to come to certain terms on how many units will be sold. Okay. So the number of units sold is dependent on the demand, and for that they should have the corresponding production. So it depends on number of units produced. Number of units produced. Let's say they are producing 10,000 units. They are producing 10,000 units. And of the 10,000 units, they are selling 8,000 units. It means 2,000 units are going to be in stock, finished goods. So whether they will be able to produce this number of 10,000 units, what is the linkage here? You have to satisfy yourself whether they are really capable of producing 10,000 units. For that, you have to see at what capacity they are going to operate. Capacity utilization. Okay. And this capacity utilization is connected with the machinery, which is going to decide the final output. So if the machinery what they are going to purchase with the proposed project is capable of producing only 8,000 units in a year, then do you think they will be produced 10,000 units in a year? If this machinery is having the capacity of producing only 8,000 units per annum, then do you think they'll be able to produce 10,000 units? Answer will be straightforward no. But for that, there can be a substitute answer. Yes, it is possible if they work on 2 shifts or if they work on 3 shifts like that. Okay. But if I give you the information that this is the maximum production possible, okay, based on their optimum capacity utilization, then this 10,000 is ruled out. This 10,000 is ruled out. So here their maximum capacity is 8,000 units per annum. That's what they can produce. And not every business will achieve 100% capacity utilization in the earlier years. Maybe in year one, their capacity utilization will be like 60 to 70%. In year two, they'll go like 75 or 70%. Year three, 75 or 80. Year four onwards, they pick up. And that depends again on number one, the support of the machinery, whether the machinery is capable of scaling the capacity at this faster pace, number one. Number two, whether this company is able to push the product in the market. The demand is so high, so they have to increase their capacity utilization. Only if those two parameters are convinced or acceptable, only then we can think of increasing this percentage. We can think of increasing this percentage. Okay. So look at here. Here, if I want to calculate the sales, I need units sold into selling price, which is linked with the units produced. And this unit production is linked with the capacity utilization. And capacity utilization is applied on the number of maximum units that can be produced. So unless and until we get a clarity, and if you want to get a clarity on what is the maximum number of units this machinery can produce, for that you have to put your base on TEV report. You have to put your base on what? TEV report. The TEV report will say this particular machinery has capacity to produce maximum 8,000 units per annum. Okay. So if they say that, you have to take that as a base. And the same TEV report also will say in the initial years, because of teething issue or stabilization, all those, the capacity utilization can be assumed at around 60 to 70%. If this is the level they give, then here you cannot think of anything higher than that. Okay. So if the customer is objecting to this, then you can have a discussion with the customer and TEV report and try to understand or get the realistic picture. But if they record it in the TEV report, then for you deviating from that can even become attract serious consequences for you. Okay. So here 8,000 units is the maximum capacity. Capacity utilization in the first year is assumed at 60%. So 8/6 or 48. So here you can think of the number of units to be produced at 4,800, and you won't sell all the produced units. Okay, something will go in stock according to the finished goods holding period that you are going to assume. Let's say out of 4,800, 800 units are in stock. It means what can be sold is only 4,000. And again, the next question is at what price you are going to sell? Are you going to sell it at some random price? Okay, because you cannot sell it at random price. The selling price should take care of two things. One, it should take care of recovery of cost. Whatever the cost incurred, that should be recovered. Number two, it should take care of some profits so that profits are adequate enough to pay loan interest, loan principal, and reward the owners and contribute to the day-to-day working capital management. Okay, so this selling price should take care of this, number one. But if the recovery of cost and profit is going to be so significantly high and much, much higher than the competitors, then you may not be able to sell at this particular price. Let's say your selling price works out to 75 per unit and everyone in the market are selling it for 50 per unit. Do you think you will be able to penetrate into the market? it's going to become challenging, right? So again, here also some kind of a discussion and validation have to be made. Only then you will be able to come to the eventual calculation on what is sales. So understand, you have to do this calculation for each and every year. For entire year 1 to 8, you have to do the sales calculation. It means for all the 8 years, you have to project what will be the selling price. This selling price may be same across 75 years on the conservative angle, or you can provide for some marginal increase in selling price. And in this 8 years, the number of units sold will keep on be increasing with the increase in capacity utilization, right? So accordingly, you will arrive at sales estimate. Like that, for each and every item, you have to sit and calculate what is going to be the cost. If it is raw material, it is going to be linked with the production. For producing, here, how many units are sold? 4,000. But how many units are produced? 4,800. For producing 4,800 units of finished goods, how many units of raw materials required? So you have to go one step down further. How many units of raw material is required for producing 1 unit of finished goods? If if you have this data, then extrapolating for 4,800 becomes simple. And once that is finalized, then at what cost these raw materials are going to be purchased? You cannot take any cost blindly. You have to see what is the raw material cost in the market now. You have to see from which suppliers they are going to purchase the raw material, at what cost, whether any discounts are available. Okay, you have to take care of all those, and then only you will be able to arrive at the raw material cost. Similarly, for producing 4,800 units in a year, how many laborers are required? So what is going to be the labor cost? And how many units of power are going to be consumed? What is the fuel consumption? What is the transportation cost? Everything you have to link it with the units produced. Units produced becomes the base, because out of produced, certain will get sold, certain will remain as a stock. So where you have to put your focus, the focus should be on number of units produced. Like that, you have to calculate for each and every year, and then only you will be able to arrive at profit. Okay, and then only you will be able to arrive at profit. Then what you have to do, you have to compare this profit with the repayment obligation. Okay, so I'm giving you a macro picture only. I'm not going, or I'm not digging deeper into micro items. Okay, but my question is, are you all able to follow with me? Still till here, are you all able to follow with me? Yes. I just need one reply. Yes. Ajay Kumar, Devanand, Surinder, Bala, Arun Singh. Actually, Surinder Singh is a entrepreneur, ex-banker, and taking responsibility for a big manufacturing plant launched very recently. I'm glad that he is sitting and attending this session. Yeah, Arun Singh, yes, okay, listen. So now where I'm going to put my focus, let's see. For this 8 years period, I told you, you have to calculate what is going to be the sales, what are going to be the expenses. So from sales, if you deduct expenses, you will arrive at profit. But this profit is before paying taxes. So you have to provide for taxes. So what you get is profit after tax. This is profit after tax. I call it as PAT. Okay. And I told you it has to be done for all the years. So 1, 2, 3, 4, 5, 6, 7, 8. Let me give you some numbers. Let me take you through one imaginary picture. Let's say in the first year, the sales is like 10 crore. Second year, it is 12, 14. Then it was freezed at 14. I mean, there is a possibility it will increase, but what the bankers will do, they cannot foresee a very long future, right? So they may freeze the numbers after reaching the optimum capacity utilization. So here, if you see the first year, they are just they've just completed the project, and they started making revenue. They have only 10 crore. And let's assume that they were operating this at a lower capacity utilization, say something like 60, 70, and the capacity utilization has increased, and it has increased, and they want to, I mean, the borrower itself says this is the maximum revenue they can achieve with this capacity. So what the banks will do, they will freeze the turnover at this level. They will freeze the turnover at this level. It means after year 3, there can be increase in sales, maybe on account of increase in selling price, on account of a slight increase in capacity utilization. Okay, but since these are all in distant future, they will avoid all those and freeze it. Then there should be corresponding expenses. In the initial period, that is, let's say in the first year, their expenses will be high, quite high. They may not be making matching revenue. Okay, let's say in the first year, their expenses is 10.5 crore. It means they have a loss of 0.5. So no taxes. Profit after tax is also at loss position. And in the second year, they were somewhere at around 11 crore and they have made a profit of 1 crore. Taxes paid is around 30 lakhs. So they have profit after tax of 70 lakhs. In the third year, okay, there is a better growth. In the third year, they capped their expenses at around 11.5 crore. Okay, so now it's going to be like 12 and 2.5 crore is the profit. And let's say around 75 lakhs has been paid towards the taxes. It means around 1.75 crore. Now, beyond this, what can happen? Beyond this, actually, there can be a marginal increase in sales, which we have arrested. We have not anticipated a future additional income. So in the same way, we can project here also. But what will happen is the expenses will reduce in future. Expenses will reduce in future for this freezed income. Why expenses will reduce? Number one, your depreciation will reduce year after year if you are following written down value method in the initial period where you will provide higher depreciation, and year after year the depreciation will come down. And if you are paying interest on term loan, for that reason also year after year the expense will come down. Okay, so because of that reason it can slightly increase. Okay, so here I keep it at this level, here I keep it at 11.7, then it can become 10.8. Let's say it becomes 10. So what is happening because of all this? The profits are increasing, right? 14 minus 11.5, it's like 2.5. Okay, whereas 14 minus 11.7, okay, 14 minus 11.7, it is 2.3. It is 2.3. Okay, and here it is 14 minus 10.8. 14 minus 10.8, it is 3.2. And 14 minus 10, it is 4. It is 4. Okay, here I'll just make one small change. Okay, the small change is over 11.4. Okay, 2.5, 2.5, and it is coming down and going up. Okay, fine. Let it be there. Let it be there. I'm not making it more complicated. So now on this, taxes have to be applied. Let's apply 30% flat tax. Okay, so 2.5 into 30% is 0.75. 2.3 into 30% is 0.7. 3.2 into 30% is 0.96. And 4 into 30% is 1.2. Okay, so we will deduct that also. And let's see what is the position. 2.5 minus 0.75 is 1.75. And this is 1.70, 1.70, is that correct? 2.3 minus 0.7 is 1.60, 1.60, 1.60. And 3.2 minus 0.96, you get 2.24. And 4 minus 1.2 is 2.8. Okay. Now, this is the projection. I mean, here I have done it very simply, but in reality, you have to validate each and every line item, each and every sub item. Okay, you have to really sit and discuss and satisfy yourself on each and every item. Okay, now what is the purpose of doing this calculation? mainly to measure repayment capacity. Somebody asked me how to calculate DSCR. I'm actually getting into that. The main objective of doing this is to measure the repayment capacity. Now, just answer me whether this business will be able to repay the loan interest and principal using this profits calculated for each and every year, assuming these profits are going to materialize. Okay. Tell me whether this profit can be used as a source for paying loan interest and principal. And I didn't give you the figures of loan interest and principal. I will give you. Okay. But my question is whether loan interest and principal can be paid using these profits. Yeah, Bala is saying yes. What about others? What do you think? Just say yes or no. Do you think we can pay both interest and principal using these profits? Okay, right. So let me give you this additional information. Follow me carefully. Additional information. Let's say the amount loan amount is rupees 7 crore. Okay, rupees 7 crore. And this loan should be repaid from year 2 to year 2 to 8. It means first year, since they are making loss, bank has also understood they have not stipulated any repayment. So this has to be repaid over years 2 to 8. It means rupees 1 crore every year. Rupees 1 crore every year. Okay, this is the principal repayment condition. And what is the interest condition? Interest is charged at the rate of 10%. And it has to be paid every year. It has to be paid every year. Okay. So for that, what we should do, first we have to calculate what is known as term loan repayment table plus interest calculation. Interest calculation. Okay. So look at here. This is year one. Year one. Maybe I'll put that here. Plus interest calculation. Yeah. So we'll take the opening balance plus drawal minus repayment, which will give you closing balance. Okay. So in year one, let's assume the loan was drawn in the beginning of the year. And what is the total loan amount? It is 7 crore, right? We are making an assumption. It's an assumption. It is drawn during the beginning of the year. Do we have any repayment in year one? Do we have any repayment in year one? Just keep answering me. There is no principal repayment, but interest have to be taken care. There is no principal repayment, but interest have to be taken care. Now tell me whether it is fair to charge them interest or give them moratorium for 1 year and include that also in the total repayment. Should we charge interest because they are already making loss? Okay. So there are two options. There are two options for this interest. If we assume that loan is drawn in the beginning of the year, then on this loan, where there is no absolutely repayment, then the closing balance will also be like 7 crore. So even if I calculate the average balance, it will be 7 crore opening balance plus closing balance 7 crore divided by 2. The average balance will also be 7 crore. So interest on average balance at the rate of 10% will work out to 70 lakhs, 0.7 crore. Okay. So I have two options. Option one, this 70 lakhs can be added to the cost of the project and bank itself can finance the borrower to pay part of the loan interest. If that is done, what will happen? This 70 lakh will get added to cost of project. Okay. And let's say the bank is giving 70% loan. It means this interest will get funded. But the only issue is it should satisfy one condition. This interest should be interest during construction period only. I repeat, if I want to put this into the cost of the project, then this interest should be interest during construction period. But here, this interest is arising in year one, where the business started making sales. Okay, they are started incurring expenses. Instead of profit, they are making losses. So this interest is not related to implementation period. Not related to implementation period. So if it is not related to implementation period, I cannot capitalize this. So the only option available in front of me is to give a moratorium. Are you all getting this? Are you all getting this? Why I am not capitalizing this interest? Why I am taking the moratorium route? Do you want me to repeat this? Do you guys want me to repeat? Okay. Okay, just listen. I'll take this in a new sheet. So what is the loan amount here? 7 crore. Okay, let's say the cost of the project is 10 crore. And this project is funded through two sources. One is term loan of 7 crore and the other one is margin of 3 crore. Okay. Now, if the project is taking 1 full year, if the project is taking 1 full year for implementation itself, okay, then in this implementation period, if we assume that loan was drawn in the beginning and they are taking 1 year for implementing, then on the 7 crore, they will pay interest of 10%, which is 70 lakhs. But this interest of 70 lakhs is arising during implementation period. What is implementation period? The project yet to commence its commercial production. Various stages of construction are still happening, but in that period, since the loan amount was drawn, interest is calculated. Okay, so if that is the case, then that interest which is arising during the implementation period can be capitalized, as per generally accepted accounting practices. For that matter, it is Indian or Ind AS or accounting standards. This is the provision available. So what the banks will do, banks also recognizes that this 70 lakh, it is not fair to expect the borrower to repay all this because the project has not even started generating revenue. How they will pay? So what they will do, they will add this 70 lakhs also to the cost of the project. So the cost of the project will become 10.7 crore. It will become 10.7 crore. And on that 10 percentage will work out to 10.7 into 70%. The loan amount will get revised as 7.49 crore. 7.49 crore. It means what? He has to bring additional margin of another 30 lakhs. Am I correct? 70 lakhs into 30%. He has to bring in another margin of 21 lakh. So the total margin which the borrower has to bring in will become 3.21 crore. And what the term loan bank will give is 7.49. So understand, bank is giving an additional term loan of 49 lakhs. Borrower is expected to bring in an additional margin of 21 lakhs. So 49 plus 21 makes 70 lakhs. Why this 70 lakhs? This 70 lakhs is for paying interest during construction. Interest during construction. Is this clear for all of you? Number one, is this clear? Interest during construction. All of you, please participate. Yeah, Devanand, Bala, Milind, Shivam. Okay. Then where does the concept of moratorium comes into picture? Okay, listen. Project, we just starting the project here. Project work started. Okay. And it takes 1 year time period. It takes 1 year time period for the project to complete. So in this period only, whatever interest is there, we call it as interest during construction. So from year one to year two, or let me put it like this. Let me put it like this. Project work which is time zero. Time zero. The project is completed and we are having the first year financials. And in the first year financials, their position is going to be loss. Why? Because it's going to take time for them to turn profitable because of the project gestation period. So in this period, even though they started generating revenue, they cannot pay. Why? Because they're as per design itself, they are going to have loss. So since you are going to know very well in advance that they are going to face loss, why do you want to pressurize them to pay interest? Okay. Because you are the main person who are responsible for giving shape to this project itself. Then you yourself cannot pressurize them. So you are aware that as per the financial estimates, you are aware that in year one, they are going to have loss. So give them moratorium. Give them moratorium as per your bank policy. If your bank policy permits 12 months moratorium, you can consider even 12 months moratorium. Okay. If they are capable of turning into profit in 6 months period, then give the moratorium only for 6 months period. By doing so, you are ensuring that whatever the interests that are calculated in this period is not going to be serviced, but rather it will get added with the loan amount. It will get added with the loan amount. Okay, now let's come back here. So here in year one, they have already availed 7 crore. Okay. Let's say already availed and project is completed. So this is the first year financials. So prior to this, interest during construction, everything is done and over. Now year one financials are available. On an average, they have drawn 7 crore. Interest is at the rate of 10%, which is around 70 lakh. But this amount he is not going to service. Why? Because he is given a moratorium for the known reason they are going to suffer loss. So what we can do with this moratorium? Shall we go and add this moratorium with the term loan outstanding? Shall we? Yes. So what we'll do? The loan amount is not just 7 crore. It's going to be 7 crore plus 70 lakhs. It's going to be 7 crore plus 70 lakhs. So it is 7.70 crore. And this 7.70 crore only have to be repaid over a period of 7 years from year 2 to 8. And the repayment is not going to be 1 crore. Rather, it will be 1.1 crore. It will be 1.1 crore. Is that clear, all of you? Is that clear? 1.1 crore. Okay. So here it means for the next year, what will happen? The opening balance will be 7.7 crore. Opening balance will be 7.7 crore. There is no repayment, but there is no drawings, but there is a repayment of 1.1 crore. If that repayment happens, the closing balance is going to become 6.6 crore. Now, what is the average balance? The opening balance of 7.7 plus closing balance of 6.6 divided by 2. Okay, 7.7 plus 6.6 divided by 2, you will get the average balance as 7.15 crore. In that 10 percentage will work out to, 0.715. That is 71 lakh 50,000. This is going to be the interest for the second year. With me, all of you? With me? This is going to be the interest for the second year. Okay, listen. Now, in the same way, we will calculate for the third, fourth, up to eighth year. Please help me with the numbers. So what is going to be the opening balance for the third year? Let me just draw the lines. Okay, I have one small feedback question. How many of you like this way of presentation where I write and teach instead of using the PPT? How many of you really like this way of teaching? That is, instead of using the PPT, I'm using our traditional school old model for teaching professionals like you. You like this? Thank you. Yeah, thank you so much. And this is the reason I refrain from using PPTs nowadays. Earlier, I used to do, but I felt that the learning experience improved significantly for the learners when I started teaching in this model. And I was really surprised by looking at the way I got responses. And then I understood that this is a way in which we learn many unwanted things. Why not let us learn wanted things in this fashion? Right? I think if you go back to your school days, you'd have mastered really complex mathematical theorems. Okay, if you go back to calculus, derivation, integration, all those, no? But we managed to solve all those, right? But the unfortunate thing is we are not getting an opportunity to apply. But how did we manage to learn all those complex things which we have never seen in real life? Can you connect the dots? In schools, we mastered many things. Actually, we scored good marks in those mathematics or many other areas, which we never saw them in real life, but we got it through that simple blackboard writing. Okay, so I just got a grab of it and deployed here. That's it. Okay, now let's move on. So the opening balance for the next period, that is the year 3, is going to be this 6.6. No drawal. Repayment is going to be 1.1. And what is going to be the closing balance? Closing is 5.5, and somebody gave me the average 7.315. Okay. If it is different, somebody correct me. Let one person give me the value, the other person correct it. Okay. So this is going to be 7.315, and this is what? This is average balance. And on this average balance, let us calculate the interest. So 10% interest will work out to 0.73. Now, is this correct? Average balance 7.3. I have a doubt. 6.6 plus 5.5 divided by 2. Hey, it's 6.05. Sorry. It is 6.05. The average balance works out to 6.05. Okay, how I am calculating average balance? I'm taking opening balance, adding closing balance, dividing it by 2. That gives me average balance. Okay. Yeah, we'll come to that. We'll come to that. Yeah. So 6.6 plus 5.5 divided by 2, you get 6.05. On the 10 percentage, we will call it as 61 lakhs. And for year 4, what is the opening balance? 5.5. No drawal. There is a repayment of 1.1, and closing balance is 4.40. So 5.5 plus 4.4 divided by 2, the average is 4.95. And on that 10 percentage works out to 49 lakh 50,000. I'll just round it as like this 50 lakhs. And for year 5, what is the opening balance? 4.4. No drawal. There is a repayment of 1.1. So closing balance is 3.3. So 4.4 plus 3.3 divided by 2, you get 3.85 as average balance. And on that 10 percentage works out to 39 lakhs. Year 6, what is the opening balance? 3.3. Nil repayment, sorry, nil drawal, repayment is 1.1. So the closing balance is 2.2. 3.3 plus 2.2 divided by 2. And it works out to 2.75. 2.75 into 10 percentage is 28 lakhs, 0.28. And we are moving to the last year. 2.2 is the opening balance. No further drawal. And repayment is 1.1. So closing is 1.1. So 2.2 plus 1.1 divided by 2. You get 1.65 as average. Interest is around 17 lakh. Okay, this is the last year, right? 8th year is the last year. This is the last year. Yeah. Opening balance is 1.1. No drawal. Repayment is 1.1. And closing balance is 0. So the loan is fully closed. So 1.1 plus 0 by 2. 1.1 divided by 2. That is 0.55 is the average balance. Into 10 percentage, interest is around 0.066 lakhs. So we have calculated interest. We have calculated interest. Okay, Ajay Kumar has an observation. Now, my question is whether this profit is adequate enough to pay this principal which is this, and interest, which is this. Are we looking at it correctly, first of all? Are we looking at it correctly, first of all? Okay, so you are saying this is the profit available, and we are saying using this profit, this principal can be repaid, this interest can also be repaid. Okay, let me take you through in the next sheet. So we have year 1, 2, 3, 4, 5, 6, 7, 8. Okay. So the first point is the profit, right? This profit figure is something like this. In the year one, let us not calculate because it is under moratorium. Okay. So let's put our focus from year 2. So not applicable. Year 2, what is the profit after tax? It is 0.70. It is 1.75, 1.75, 1.60, 1.60, 2.24, and 2.80. Okay. So my question is whether we can use this profit to pay the interest and principal. Okay. Whoever said yes, you need a learning now. See, this profit was arrived after subtracting all the expenses. And let me tell you, these expenses include this interest also. Okay. This profit was arrived. This profit was arrived after subtracting all expenses. So these expenses include this interest as well. So we should not say this profit is available for paying interest. This profit is available for paying loan principal. This profit is available for paying loan principal. Okay, so if you want to know what is the profit available for paying both interest and principal, what you have to do? You have to go one step back. Here you have profit after tax, right? So with this, if you go one step back and remove the expenses included here, I mean, remove the interest included in the expenses, you will get a better picture. You will get a better picture. So what we can do with this profit after tax, okay, I'll call this as PAT. What you can do? You can go and add back interest on term loan, what we have calculated, interest on term loan. Okay, moratorium period, let us ignore. Let's start from period number 2. So this 0.715, I'll round it off as 72 lakh. So I'm adding 72. I'm adding 72. I'm adding 61. I'm adding 50. I'm adding 3928. 3928. I'm adding 17 and 6. 17 and 06. Okay. And let me also tell you one thing. This profit was arrived after subtracting all expenses, right? And this expense also include one item called depreciation. It also includes one item called depreciation. Depreciation is an expense or loss booked, but there is no cash outflow involved. There is no cash outflow involved. So we need cash profit for paying the loan. But this profit was arrived after subtracting non-cash expense. So what we should do? This profit was arrived after subtracting depreciation, which is a non-cash item. So if you want to know what is the profit before providing for depreciation, you have to compensate by adding it back. Yes or no? Let's say, for example, this profit of 70 lakh was arrived after subtracting depreciation of 20 lakhs. So if the depreciation had not been provided, this profit would have been 90 lakhs. Yes or no? If that 20 lakh depreciation was not provided, this profit would have been 90 lakhs, right? So what we can do, we can add back depreciation figure. So that's what I'm going to do. Let me add back depreciation. if I add back, let's say now for simplicity purpose, I'm not going deeper into that. For simplicity purpose, let's say this company is following a straight line method of depreciation, and every year depreciation figure is something like 40 lakhs. Okay, it is a uniform figure. In reality, it can be uniform, it can be different also, depending upon which method of depreciation they are following. Okay, now you see we have a profit. By adding back interest, we got to know what is the profit before paying interest. And by adding back depreciation, now we literally have idea about the cash profit of the company. Okay, we have idea about the cash profit. Okay, please total and tell me the cash profit for each and every year. 0.7 plus 0.72 plus 0.4. This is 1.82. 1.75. Can somebody come from backwards from year 8 onwards? 1.75 plus 0.61 plus 0.4 is 2.76. 1.75 plus 0.5 plus 0.4 is 2.65. 1.6 plus 0.39 plus zero point 0.4 is 2.39. And here, yeah, 1.6 plus 0.28 plus 0.4 is 2.28. And 3.26 is for the last year, right? 3.26 is for the last year. 2.24 plus 0.17 plus 0.4 works out to 2.81. Okay, so this is the cash profit available. And using this cash profit, now you can repay the interest on term loan and you can repay the principal as well. Principal already we have calculated, right? For every year, it's going to be 1.1 crore. For every year, it's going to be 1.1. Let me put it here. And what about the interest? Already we have the figure here. I will just copy paste. Okay. So this is the interest. Let me see whether I can copy paste. Oh my God, it's making mess. Let me write it. So interest on term loan is 0.72, 0.61, 0.50, 0.39, 0.28, 0.17, 0.06. Okay. We'll do one thing now. Now we'll keep this independent. This is cash profit. This is independent. And let's also write installment. That is basically total of interest and principal. Can you please help me? The figures, it is 1.82 and this is 1.71, 1.60, 1.49, 1.58, 1.16 and 1.27. Okay, so this is independent. Yeah. Now you have cash profit and installment. So let us start comparing now. Take the cash profit, compare it with the installment. Oh my God, it's matching. So you compare the cash profit in the numerator, okay, 1.82, and compare it with the repayment in the denominator, which is 1.82. So 1.82 by 1.82, you get the value as 1. And it can be read as 1:1 also. It means for paying every 1 rupee of the loan installment, this business is making a profit of 1 rupee. Okay. Like that, please calculate for each and every year. For the second year, it is 2.76 divided by 1.71. In the second year, it is 2.76 divided by 1.71. What is our ratio? Yeah, somebody gave me it is 1.61. What is the ratio for the third year? 2.65 divided by 1.6. It is 1.66. For third year, it is 2.39 divided by 1.49. It is 1.60. Sixth year. Sixth year, it is 2.28 divided by 1.58. It is 1.44. Okay, this year it is 2.81, right? Okay. 2.81 divided by 1.27. It is 2.21. 2.21. Okay. So look at here. So you have calculated one ratio. You have calculated one ratio. Can you give a name for this ratio? Can you give a name for this ratio? A very important ratio. Yes, this is DSCR. We have calculated DSCR now. This is debt service coverage ratio. In the second year, the ratio is really weak. The ratio is really weak. In the third, fourth, fifth, sixth, seventh, eighth ratios, I mean years, it's actually better. Actually, it is very high in the year 7 and 8, and it is above 1.5 times in the period like 3, 4, 5. In year 6 and in the year 6 alone, it has come down a bit. Why it has come down in year 6? Okay, maybe the PAT, interest. Okay, let me just check. Okay. Okay, we anticipated that 1.6 plus 0.28 plus 0.4, 2.28 divided by, no, I did a mistake in year 6. 1.1 plus 0.28, no, it is 1.38. Yeah, repayment is 1.38. That's what I was wondering. Okay, so 2.28 divided by 1.38, where it is 1.65. Yeah, this is improving. Okay, so what we have calculated now is debt service coverage ratio, where we have literally compared the cash profit with the total repayment. For calculating the cash profit, what we did, we took profit after tax, we added back interest on term loan because we want to know what is the profit before paying interest. We added back depreciation because we want to know what is the cash profit. And we compared and we noticed that in year 1 alone, it is matching. In other years, it is improving. So what the bank can think of here is they can slightly modify the repayment in year 2. Instead of asking them to pay on equal footing basis, in year 2, since their cash profits could support only 1.82, even though it looks so perfect, reality can differ. In reality, what will happen if this 1.82 becomes 1.7? Okay, they will land in trouble. So what they can do, they can reduce it maybe to 50 to 60% level. So instead of 1.1, they can make it like 60 lakh or 70 lakh and gradually increase, because throughout the ratio, I mean, here, did I corrected the ratio? Yeah. Throughout the ratio is better here. They are at 1.6 level, so they can absorb some increase. And if you see in year 7 and 8, there is a lot of scope also to have some more buffer in the end. So instead of burdening them in the initial period itself, they can even resort for a ballooned payment, where there can be like stage by stage increase in payment, because we have freezed the sales. Actually, the sales can increase and accordingly the profit can also increase. So on the conservative angle, we have done that. So let us not burden this company in year 2 itself with this equal payment. Let them have a stepped up approach, and year 7, 8, you have space for increasing also. Okay, so this is how DSCR calculation is done. So how many of you believe the time you have spent on today's session is a worthy time? Worthy time. And this week I made a drastic shift in the way in which I present the term loan session, because in all session my focus used to be on designing the cost of project and means of finance. So in this session, I really wanted you guys to have another dimension to this as well. Okay, right. So wonderful. I could see a lot of positive feedbacks. And my dear Diamond members, can I have your permission to introduce our Diamond membership to these awesome learners who enjoyed the session? Can I have your permission? If any Diamond members are here, please type Diamond and permitted. Please type Diamond and permitted. Any Diamond members? Yeah, Suresh Babu. Yeah, Rajni, just give us some time. Arun Singh, Devanand. Yeah. Ashish is asking how to calculate interest on term loan. Ashish, we have explained, but Ashish, you can do one thing. Go to Credit and Financial Analysis Mastery course. There is a term loan module where this is shown in detail as well. Okay. Yes, I got the permission from several Diamond members. So all those excited learners, just stay for another 5 more minutes. You have something even more to excite. Okay. So with the permission of the Diamond members, I'm introducing our Diamond Live membership. Diamond Live membership. What is this Diamond Live membership? This is a membership program which we have designed for banking and finance professionals who are very serious about their career growth, who want to learn what matters. Okay, so this membership program will give you access to 130 plus pre-recorded online courses which we have published in the domains of banking, credit, finance, accounting, costing, and so on. This membership program will give you access to 100 plus ebooks which we have published in this domain. This membership program will give you access to all the live classes which we have conducted in the past. This membership program will give you access to all the live classes which we will be conducting in future as well. So in future, it can be a single 2 hours live class, or it can be a 1 day workshop, or it can be series of workshop programs. Okay, you will get access to all those. This membership program will also give you access to the latest developments that are happening in the world of banking and finance, which are analyzed and presented by us as conversational articles. And this membership program will also gives you assurance. I repeat, it gives you assurance of free access to all our future e-publications. That is, in future, if we are going to come out with any courses, any ebooks, any templates, any test series, any short lessons, you will get access to all those. Several hundreds of our learners have already upgraded to Diamond membership in this very short period. Say in a matter of 2 months, we have more than 600 members upgraded to Diamond membership. And now it's your turn. I'm going to give you a window, special window now, an opportunity to upgrade to Diamond membership. And for that, what you have to do, you have to take your WhatsApp now. Make a note of this number, 90251 00249. Take your WhatsApp right now and send me a message called Sunday Diamond. Okay. Send me a message called Sunday Diamond. Do it right now. If you do so, you will get an amazing, unimaginable offer for upgrading to Diamond membership, which many of the learners have absolutely loved and made use of. And for those who are watching this session in mobile, I'm giving one link. If you click the link, it will automatically open your WhatsApp and it will have the message ready, Sunday Diamond. You just have to send that message and wait for the offer. If you have already enrolled in any of our courses, you are eligible for a special discount as well. Okay, so I'm going to open my WhatsApp, start sending your messages. Even today, already 7 to 8 members who have attended today morning session have upgraded to Diamond membership. Okay, so click the link. It will generate a message called Sunday Diamond. Send me the generated message and wait for the offer. Okay, yeah. So Kavin Prasad, I have received your message. I have received your message and sending you the details now. Please check. And for others, the number is 90251 00249. Open your WhatsApp and send the message. Whoever watching this in your mobile itself, I have sent you a link in the comment section. Click the link. It will open your WhatsApp. It will have the message called Sunday Diamond. If you really enjoyed today's session, and if you want to have many more learning sessions like this, where you go deep rooted into the foundations, fundamental concepts, gain clarity, crystal clear clarity, then Diamond membership is the only gateway. So go ahead and make use of this opportunity.